let's kick off this explainer. Today, we are taking a fascinating journey through the hidden financial mechanics that keep businesses alive and ultimately allow them to scale. We're going to travel all the way from the absolute trenches of daily operations where every single drop of diesel actually matters to the massive, high-stakes world of public capital markets where companies raise millions to build their future. It's really a tale of two very different financial documents, and together they paint a complete, vivid picture of corporate survival and growth.
Here is our roadmap for today. Section 1 covers managing unpredictable material costs. Section 2, calculating the price adjustments. Section 3, raising capital for growth. Section 4 takes us inside the Poojaa IPO, and Section 5 looks at navigating potential business risks.
All right, Section 1, managing unpredictable material costs at the ground level.
Imagine for a second you're Emirates German Foundations, or EGF, and you're building a massive residential project in Abu Dhabi. Now, you quoted the job months ago, right? But you have to buy your materials today. So how do you survive if the price of steel suddenly skyrockets? Well, you survive by using a very clever contractual mechanism. Because material prices are incredibly volatile, EGF uses a framework defined in their letter of award, or LOA. This framework allows them to compare the LOA base rate, which is the expected price they agreed upon when they signed the contract, against the actual purchase cost. That's the real-world price they actually paid suppliers on the ground for things like ready-mix concrete, reinforcement steel, and diesel.
Let's move on to Section 2, calculating the price adjustments, and let's see the math visually.
So, let's look at a specific snapshot in time. We're looking at the billing period from June 10th to June 29th, 2026. This isn't just theoretical. This is the literal cost of doing business, day by day. For ready-mix concrete and reinforcement steel, EGF ended up paying more in the real world than their base rate estimated. That resulted in positive variation claims of over 27,000 and 31,000 dirhams, respectively. But here's the twist. Look closely at the diesel row. The actual cost of diesel for the 9,157 liters they consumed was just over 28,000 dirhams. That was significantly lower than the contracted base rate of over 38,000 dirhams. Because the actual cost fell below that base rate, this actually acts as a credit adjustment of 9,706 dirhams back in favor of the employer. It's totally a two-way street.
By painstakingly tracking these minute daily details, and let's be honest here, somebody is literally sitting in a site office matching hundreds of crumpled supplier tax invoices to muddy concrete pour records, which sounds like an absolute nightmare. EGF secures a net material price adjustment of exactly 49,139 dirhams and 69 fils for just a 19-day period. This unglamorous, highly detailed reality is exactly how a business legally protects its bottom line from being eaten alive by inflation and raw material volatility.
Which brings us to Section 3, raising capital for growth, the macro shift.
So, you've optimized your daily margins, and you're tracking your materials perfectly. But what happens when a business isn't just trying to survive daily cost fluctuations, but actually wants to double or maybe triple in size? When a business wants to scale way beyond daily operations, how does it fund that massive growth? I mean, bank loans can only take you so far, right? To answer this, we shift our focus over to our second source, the Draft Red Herring Prospectus, or DRHP, of Poojaa Precision Engineering Limited, based over in Pune, India. The answer, for them, is going public. Poojaa Precision Engineering is initiating an initial public offer, putting up to 5,310,000 equity shares, that's 53,10,000 shares, at a face value of 10 rupees each, to the public. They are taking a massive leap from fighting for a few thousand dirhams on concrete to opening up ownership to everyday investors and massive institutions to secure millions in cash. And the primary goal here? It's to fund a massive scale-up of their annual production capacity with a brand-new, state-of-the-art manufacturing facility in Pune.
Section 4, inside the Poojaa IPO, unpacking the financial engine.
You know, a prospectus is basically a financial X-ray. Before anyone buys a single one of those 53 lakh shares, they absolutely need to know what they're buying into. And honestly, before looking at the cash, smart investors look at the human engine driving the IPO. Headed by Chairman and whole-time Director Anil Shivajarol Kulkarni, you can see a deeply structured hierarchy. It spans from the Managing Director all the way down to highly specialized roles like the head of the foundry, the plant head for the machine shop, and dedicated corporate compliance officers. Investors aren't just betting on a factory, they are betting on this specific team's ability to execute that expansion.
And historically speaking, this team has delivered. The financial numbers show a very healthy trajectory. Their profit after tax bumped up to 1,609.65 lakhs in fiscal year 2024. That is a really solid 14.14% year-on-year growth. The prospectus attributes this margin improvement to better operational efficiency, improved cost absorption, and, this is key, particularly strong growth in their new electric vehicle or EV segment.
But hold on, when you really dig into their revenue streams, a very specific reality check emerges. As of September 30, 2025, they are overwhelmingly dependent on the traditional automobile sector. It accounts for over 70% of their total business. The non-automobile sector brings in about 21%. And while that EV sector is generating a ton of buzz right now, it still only represents roughly 8.9% of their revenue. So at their core, they are heavily reliant on traditional automotive manufacturers. So why the urgent need for millions in public capital right now? Well, the capacity utilization data reveals the bottleneck. Their melting capacity is currently sitting at 62% utilized, with casting and finishing operating at 70%. They are quite literally pushing against the limits of their current infrastructure. To capture more market share and actually fulfill the demand they're seeing, they have massive room to scale, but they absolutely need that new manufacturing facility to do it.
Moving to Section 5. Navigating potential business risks, the small print.
Now, a draft red herring prospectus is definitely not a glossy sales pitch. By law, it must rigorously and impartially outline the severe risks the business faces. If you're going to invest, you need to know what could go wrong. First is that heavy dependency on the traditional automotive sector we just talked about. If the auto industry dips, Poojaa dips. Then there's the risk of unanticipated delays for the new facility itself. And notice the third point here, vulnerability to raw material supply disruptions. This links perfectly back to our very first document from the UAE. Raw material availability can choke a business overnight. They also face strict environmental laws. And, perhaps most terrifyingly if you're an investor, they explicitly state that their directors currently lack experience managing a publicly listed company, which brings a completely new, intense level of regulatory scrutiny to the table.
Which brings us to the ultimate takeaway from our explainer today. We've seen a company in Abu Dhabi fighting for literally every dirham on daily concrete and steel prices, and a company in India restructuring its entire existence to raise public capital for a massive new factory. It leaves us with a compelling thought. Is long-term business survival ultimately about the defensive game of mitigating daily operational costs or the offensive game of securing massive injections of public capital? The truth, as these documents reveal, is that to truly succeed, a company has to master both. Thanks so much for joining me on this deep dive into the real mechanics of corporate finance. Catch you next time.